Hi there. As you saw from the title of the video, this video is for chapter 3, the first video in chapter 3, and chapter 3 is titled as Adjusting the Accounts. So you may remember that at the beginning of chapter 2, we discussed the 3 chapters neck to neck. Chapter 2, chapter 3, chapter 4. Chapter 2 is mostly about and chapter 3 is about adjusting. Entries, and chapter 4 is about closing entries. And as you saw at the last class, the chapter 1 was journal entries are prepared during a period. It can be a month, it can be a quarter, it can be a year. Anyhow, during a period, whenever you have a transaction, you record it, and they are called journal entries. But unlike journal entries, adjusting entries and closing entries are prepared at the end of a period. For example, if you are talking about a year, then I say that majority of firms are using December 31st as their fiscal year ends. In such a case, adjusting entries and closing entries are prepared at the end of December 31st of a year. Okay, then that said, what are adjusting entries? To talk about that, we need to understand accruals. Accounting versus cash basis, accruals basis accounting versus cash basis accounting or cash accounting in short. Then what's accruals accounting and cash accounting? I have a funny story actually about that. I'm an accounting professor, and I once visited a doctor's office, not a doctor like me, but MD, medical doctor's office. It was my first visit of his office. Actually, it is not, he is affiliated to a larger group of medical doctors, which is often called as a partnership of across many medical doctors. So he is one of the doctors in that group organization. And it appeared that the doctor recently joined that organization, that hospital. And it was my first visit of meeting him. As you know, the first meeting with a doctor is usually telling about you, right? You are asked to prepare like a bunch of pages, 5 pages long about you, right? What's your history? What's your background? What's your job, right? And the like. So I wrote as detailed as possible, including my job. I'm an accounting professor. And then I wrote them and then gave it to the front desk. And then a few minutes later, the front desk called me, go to that room 6 or something like that. So I went to the room, and then there was a nice gentleman. That must be the MD. So I said hello, and then we made a greetings. And then he said that, looking at the file that I have written down, he asked me, you are an accounting doctor? So I said yes. Okay, accounting professor. So I said yes. And then he, you know what? He asked me a question that I least expect from an MD. You know what's that? He asked me, oh, you're an accounting professor, then you know the difference between accruals accounting and cash accounting. What? This question is from an MD. Wow, I was shocked. Okay, why did he ask that? He asked me that because he recently realized that after getting his first salary from the hospital, from the organization, he expected that he will get the salary based on the number of patients he met. Like, let's say that he met 10 patients over the month, and each patient is supposed to pay, I don't know, $1,000, meaning he was thinking that he will receive $10,000 as his gross salary at the end of the month. But he found out that he received only like much less than that, right? When he expected, he thought. Then, why this happened? He told me that the hospital is using cash accounting, and he thought he will receive the salary based on accrual. Accounting. What does that mean? Out of 10 patients, the setting is like only 3 patients paid cash. Okay? What I meant was the doctor met. The doctor met 10 patients and then provided his service, right? What's the term that we studied last class? When we talk about the revenue, he performed the service for the 10 patients, and he expected that he will get $10,000 based on the accruals accounting. But the reality was the hospital gave him cash that the hospital received, right? So what happened? He ended up receiving only $3,000, right? This is cash accounting. As much as you receive the cash, as much as there are cash transactions, you make the record. That's cash accounting. Accruals accounting is different. Accruals accounting states that as much as you provide the service, right? You perform the obligation, right? You are entitled to record it, the revenue, the salary, right? So again, the doctor said that I thought that it would be accruals accounting, but I found that my salary is paid on based on the cash accounting. So I was pissed off. That's what he was saying. Wow. Yeah, that's one of the cases that I realized that how much non-accounting major people are involved with this kind of concepts, right? So it's good to know, right? You're in the right class. Okay, yeah, we have seen this difference between accruals accounting and cash accounting. And you may have noticed that one of the most important topic here is how to recognize the revenue. What was that? Revenue can be recognized only when. Important thing is when, right? You perform a service is performed. Your obligation is satisfied. To say simply, okay? This is called revenue recognition principle. Okay. Okay. Tell me again. Revenue recognition principle. Do you recall? Come on, I think you do. What's that? You can recognize revenue only when you perform the service. Service is performed. Right, good job. Then, what's the next topic? You saw it, right? At the title, at the cover of this video, I have written down expense recognition principle. Then, what is the expense recognition principle? To talk about that, you should know the revenue recognition principle. What's that? You can recognize expense. You can recognize expense only when you recognize revenue. Only when related revenue. Revenue is recognized. Okay. So what do you see? Expense is always following the revenue. Without revenue leading to expense, expense cannot be recognized. It's the reason why oftentimes expense recognition principle is called matching principle. Okay, because revenue is always following, expense is always following revenue. Or saying the same thing in another way around of it is, without revenue, expense cannot be recognized. Okay. So why is this so important? For example, there cannot be a standalone revenue without expense, or there cannot be a standalone expense without any revenue. Okay, all related expense should follow revenue. Okay, right. We've talked two important principles about accruals accounting, and why are we talking about this? These are the reasons why we need to prepare adjusting entries. Okay, then what are adjusting entries? As you can guess, cash accounting is you recognize, you make a record whenever there is a cash transaction. But accruals accounting, the philosophy behind it is, even though there are no cash transactions, you sometimes may have to prepare entries, okay? And they are called adjusting entries, okay? They are, again, prepared at the end of the period, and the next video, from next video on, we will talk about some examples of adjusting entries. All right, so stay tuned and see you there.